Hi there, my name's Mike Larson, and I'm editor-in-chief at the MoneyShow, and I'm excited this week to introduce you in this video interview with Kenny Polcari, founder and managing partner at Kace Capital Advisors and chief market strategy at Slate Stone Wealth. Kenny's a well-known TV personality who appears on Fox Business and CNBC and is often quoted in major print media outlets. He writes a daily morning thoughts missive. It's informative, engagement, entertaining look at global markets. And I'm pleased to announce that he is going to be speaking at the Accredited Investor Symposium in New York. So I thought this would be a great time for you to get a chance to listen to Kenny a little bit and have him introduce himself and talk about the market. So Kenny, welcome aboard.
Thanks, Mike. It's always a pleasure to be here.
I'm glad we could chat. Kenny, it's a new year, but I feel like in some regards we kind of have some of the same concerns that we dealt with in 2022 for investors, accredited investors, and really the market overall. So I was kind of curious about your take. Now that we flip the calendar, where do you see things right now, and where do you see them going?
So I think it's going to continue to be a volatile year, at least for the first quarter or 5 or 6 months. I think the Fed's going to be pushed to have to continue to raise rates beyond March because I think that they're going to realize inflation is sticky and it's not reacting as fast as they think it should. Now, guaranteed, granted, we're down from 9.1% to 7.1%. That's a great move, but we're still at 10.1%. We're still 5 percentage points away from where they say the target is, and the target currently is 2%. I also suspect that that may change too. My guess is they may change that. They may push that to 3% now being the target as they try to tamp down inflation. But one way or the other, I think all this is going to continue to add to some volatility for the markets and cause investors some short-term angst.
Sure. And it's funny. It seems like we've been dealing with the Fed forever in one form or another. First, the aggressive easing after the COVID pandemic. Now, this sort of incredibly aggressive taking back of all the stimulus. Is it ever going to be a market sometime in 2023 where the Fed's on the sidelines and we can all just start focusing on fundamentals and other things out there?
No. So here's the deal. Because to your point, the Fed's been overly stimulative for 13 years. This started, let's not forget, this started during the great financial crisis, right? When they slammed rates to zero, they cut rates to zero, they went negative in parts of the world, and every central bank around the world stimulated their economies. The Fed has been doing the same thing. Now, they started to raise rates and COVID hit, they cut them once again to try to keep the economy from rolling over. But this is not, a 2-year problem. This is really a 13-year problem, which is why I don't think, to answer your question, we're gonna get to a point yet where you cannot be considering the next Fed move in terms of building a portfolio. I think that's still a couple of years away. I think, it took us 13 years to get into where we are. It's not going to be over in 6 months, not by any stretch. So I think, investors are going to have to continue to factor that into their analysis and kind of their strategy.
Sure, completely understandable. And that kind of leads to a natural next question, which is about sector performance, places that tend to do well in a rising rate environment where the Fed's is very active versus those that do when the Fed's on the sidelines. I mean, what do you see out there in terms of where investors need to be focusing and maybe need to be a little less exposed to?
Well, I see what everyone else sees, right? All the high growth, sexy names are getting absolutely slaughtered in this rising rate environment, while I call it the stuff that people need sectors. So it's consumer staples, it's healthcare, it's energy, it's utilities, have all actually, outperformed the market, right? Energy was up 56% on the year. Yep. Oil service stocks are up nicely. Natural gas, coal stocks were all up nicely. And so therefore there was safety there. But there was, utilities ended the year flat, but you add in dividends, you're up 3 or 4%. Consumer staples, you've been flat in the year, right? And healthcare was down 3%, but you add in dividends there, so maybe you're down 1%. That's all versus down 19% in the S&P or down 33% on the Nasdaq. So you certainly found you had exposure to equities in those sectors, but you've also found some stability. And I think you have to continue to overweight those same sectors, at least going into the spring of this year. It doesn't mean you need to completely toss your tech names, but I think you do have to go through your portfolio and look at the tech names you own, right? Am I getting rid of my Apple or Amazon? Absolutely not. Am I buying more on weakness? Absolutely am, right? Because I don't. First of all, it's very much part of well-diversified portfolio. But do I own Teladoc or Zoom? I don't. I never did. Am I owning Meta? I'm not. I don't care how cheap Meta gets. It's just not a name that I'm in, right? I don't like it. I don't like Facebook. I never used it. And so therefore I'm just anti-Meta. So I will never own Meta no matter what it does, right? I miss Tesla on the way up, but honestly, Tesla's getting to a point where it might start to look like a value play. And that's what you have to start to think about. Some of these tech names, some of these names that got really slaughtered, go from this high growth, sexy name to value. And so, and you and I both know, the minute this market turns, the minute there's a catalyst that's going to cause this market to turn, all these sectors that have gotten beaten up, communications, consumer discretionary, all these sectors of real estate that have gotten absolutely beaten up last year are going to be the first ones to rally the hardest, because they're the ones that are going to have all the opportunity in them, right? And so you just have to be nimble enough to be able to incorporate that, right? Maybe you don't want to hold it. Maybe you don't want to own them now. Maybe you're still concerned, but you want to have the kitty set aside so that when you make that decision, you don't have to go selling other stuff to get the money to buy the stuff. You want to be able to buy it. You know what I mean?
Yeah, no, absolutely. Absolutely. I guess without stealing too much of your thunder, we're going to be meeting in New York for the symposium in late February. I just want to know, are there things that you think, you're kind of already thinking about that are going to be important to bring up for investors that attend, and any pointers that I guess, again, if you want to give a little sneak peek of what you might be talking about, you'd want to throw out there now?
Well, the broad idea is to talk about investing into a rising rate environment, very much like what it was in 1979, 1980, 81. Now, I understand the markets are very different today than they were. Yet, we all remember most of us will remember what the Fed did in 79, 80, and 81 when Paul Volcker had to, they raised rates, and they pulled back. They were trying to pause, and inflation did not respond. And ultimately, he had to jam rates significantly up and above the CPI. And that created a very long, deep recession in this country. And then, where investors found safety, where they found opportunity in that environment. Now, I don't suspect it's going to get that bad, but look, we're in a very different spot. The Fed, like I said, the Fed's been simulating for 13 years, both on the bond side as well as on the rate side. So that's all changing, and rates are normalizing. Having rates back at 5 or 6% is normal, whether anyone wants to believe it or not. There's a generation and a half of people that think zero rates is normal. Zero rates is not normal. So, that whole generation is going to have to get used to the idea that how do you invest when rates are 5% and bonds are really, or even bank CDs are challenging investor assets, right? You could take some of your money and put in a 3-month T-bill right now and roll it every 3 months and get 4.25% as of this morning. And you could just roll it every 3 years. It keeps you liquid, but you're guaranteed, you're riskless, you sleep at night, you don't worry about it. So if you're someone who's really worried about another significant drop, Morgan Stanley and Goldman are calling for, another 22% drop from here. S&P 3000, which I think that's a little bit dramatic. But I think those are things that investors have to think about. And that's
100%. I definitely think
it's part of my presentation.
If you told some people out there right now that they could have once paid 13 or 14 or 15% on a mortgage, I think you get some pretty odd stares depending on how old they are. So
my first one was 15.5%. You know what I mean?
There you
on
go.
My mortgage. So I lived it. I was 21 years old in 81 and 82 when that was all happening, right? And so I rode that wave down. And so I think there's a whole generation of people out there now who only, like I said, who only know zero rates and an accommodative Fed, and they're doing anything anyone wants, and every time someone stamps their feet, the Fed pulls back. You and I might remember those days. Well, I certainly remember. Alan Greenberg, a Greenspan, used to come out on Thursdays, open the book. Here's what we're doing. Close the book and walk away. He didn't sit there and hold anybody's hand. He didn't say, "Come lie down on the couch. Let's take a Xanax and talk about it." He left it up to the market to figure it out. And I think on a certain level, I think that's what has to happen. But the Fed has to let go, and the Fed can't let go yet just because there's too much invested.
Kenny,
right?
I think that perspective is great. I mean, again, investors are gonna get a lot out of hearing a perspective of somebody who's been around the block a few times and knows that you have to do you have to invest differently. You have to invest in different assets, use different strategies, all kinds of things in this sort of rate environment versus what we've had for so long. So
Yeah.
it's great perspective. I wanted to thank people for watching this. I hope you enjoyed the interview, and if you did, you're gonna love seeing experts like Kenny in person. You're going to get to ask questions you might have about their unique investment approach, interact with some of the smartest people in finance. All you got to do, check out the link in the video description below. You'll get some more details. And I think that'll show you how you can be in the room at the Accredited Investors Symposium. So thank you for watching. Kenny, thank you for your help. And we'll talk again soon.
It's always a pleasure, Mike. Thanks for the call.
Cheers.
Bye.